Most people watch the stock market crash and their hands freeze. The screens flash red, panic fills the air, and fortunes evaporate into thin air, or so it seems. Warren Buffett watched those exact moments of terror with a completely different emotion: quiet excitement. While the rest of the world runs for the exit doors, running away from falling prices like a house on fire, Buffett looks around and quietly asks himself a single, counterintuitive question. Which of these great businesses are being put on sale today? We are conditioned to fear loss, to treat a declining market like a disaster, and to run away from uncertainty. Yet history tells a vastly different, almost secret story. One where the greatest wealth transfers in human history never happened during bull markets, booms, or economic peaks. They happened in the dark, chaotic moments of absolute panic, when fear created millionaires out of ordinary people who simply knew where to look. If you have ever felt your stomach drop watching your portfolio dip, or wondered how the legendary investors managed to stay completely calm while everyone else loses their minds, you are about to discover the exact psychological shift that changes everything. Let us step behind the curtain and look at how fear actually operates, how human psychology sabotages our greatest financial opportunities, and how Warren Buffett turned market terror into the ultimate wealth-building engine. Imagine walking into a high-end luxury store where everything you have ever wanted is suddenly marked down by 50%. The designer suits, the timeless watches, the prime real estate, all slashed to half price overnight. In any normal retail setting, people would line up around the block, elbows out, fighting to grab the bargains. Yet when it comes to the stock market, the greatest supermarket of businesses in the entire world, the exact opposite happens. When prices drop, when great companies go on sale, the crowds do not line up to buy, they line up to run away. Sirens wail in the media, talking heads scream about impending doom, and retail investors dump their valuable assets for pennies on the dollar, driven by a primal biological urge for self-preservation. This is the great paradox of financial markets. Price and value are constantly at war, fueled entirely by human emotion. When times are good and optimism is high, people overpay for mediocrity simply because everyone else is doing it. They feel safe in the herd even as the cliff approaches. But when uncertainty strikes, when a crisis hits, headlines turn blood red and fear takes the steering wheel, the herd panics. They mistake a drop in price for a drop in business value. Warren Buffett understood this behavioral flaw better than almost anyone in history. He realized that the stock market is essentially a manic-depressive business partner named Mr. Market, who shows up every single day offering to buy your shares or sell you his at whatever price he happens to be feeling at the moment. Some days Mr. Market is euphoric, seeing nothing but endless blue skies, demanding an absurdly high price for his stake. Other days he is utterly depressed, convinced the world is ending, and practically begs you to take his shares off his hands for next to nothing. Most people make the fatal mistake of letting Mr. Market's emotional state dictate their own. When he is excited, they get greedy and buy high. When he is terrified, they get scared and sell low. Buffett did the exact reverse. He treated Mr. Market's emotional instability not as a guide to follow, but as a weapon to use against him. To understand how this works in real life, you have to look past the ticker symbols and flashing red numbers on a screen and remember what a stock actually represents. Ownership in a living, breathing business. When you own a piece of a great company, a business with strong cash flows, loyal customers, and an economic moat that keeps competitors at bay, its intrinsic value does not plummet just because the stock price drops 50% in a week. People do not stop drinking Coca-Cola, using credit cards, or needing insurance simply because the economic headlines are gloomy. The underlying engine of the business keeps running, keeps generating cash, and keeps serving customers. Yet, the price attached to that engine fluctuates wildly based on how nervous human beings happen to feel on any given Tuesday. This disconnect between price and value is where true wealth is forged. When fear grips the market, it compresses valuations indiscriminately. Good companies and bad companies get thrown out together like bathwater and babies. Investors who are paralyzed by anxiety miss the forest for the trees, focusing entirely on short-term pain while ignoring long-term compounding. They forget that every single major economic crisis, every panic, every crash, every bear market has eventually been followed by a recovery that reached new highs. Without fail, every single time. The pattern repeats itself across decades because human nature never changes. People panic because our brains are hardwired for survival, not for financial spreadsheet analysis. When ancient humans heard a rustling in the bushes, the ones who survived were the ones who assumed it was a predator and ran away immediately. They did not stick around to analyze the probability of it being a harmless rabbit. That same evolutionary survival mechanism is what makes modern investors panic at the sight of a falling portfolio. Your brain is telling you to drop the asset and run to safety, treating the brokerage account like a literal predator chasing you through the brush. Buffett's genius lies in overriding that primitive biological programming through sheer discipline, rigorous preparation, and a radically different mental framework. He trains his mind to view a market crash not as a disaster to flee from, but as a rare, beautiful clearance sale funded by other people's panic. Consider what happens when everyone else is selling out of sheer terror. Liquidity dries up. Sellers outnumber buyers 10 to 1, prices plunge far below what the assets are actually worth. In that exact moment of maximum pessimism, cash becomes king. While others are forced to sell at a loss to cover their debts or soothe their anxiety, the investor with dry powder cash reserves sitting patiently on the sidelines steps into the void. They do not rush, they do not panic. They calmly pick up exceptional assets at bargain basement prices, knowing that time is on their side. This is how multi-generational fortunes are quietly built while the rest of the world is hiding under their beds. It requires a level of emotional detachment that feels almost unnatural to most people, because it goes against every social cue and biological instinct we possess. When your neighbors are whispering about ruin, buying requires courage. When the news anchors are wearing grim faces and talking about depressions, buying requires conviction. And that conviction does not come from luck or blind optimism. It comes from deep understanding. Buffett could buy aggressively during the darkest hours of financial panics because he had spent decades studying the underlying economics of the businesses he wanted to own. He knew their profit margins, he understood their debt levels, and he trusted their management teams long before the crisis ever began. When the storm hit, he did not have to guess whether the company would survive. His homework was already done. That preparation is the invisible shield that separates the panic seller from the calculated accumulator. Most people enter the market without a thesis, without an anchor, and without any real understanding of what they own. The moment the wind blows against them, they realize they are standing on glass. They sell because they are flying blind, guided only by the fluctuating emotional barometer of the crowd. To break free from this cycle, you have to stop looking at your portfolio as a scoreboard of your self-worth or a casino wheel spinning your destiny, and start viewing it as a portfolio of operating businesses. If you owned a local bakery and the economy took a dip, would you run out into the street and scream at passersby to buy your ovens for 10 cents on the dollar just because people were feeling gloomy that week? Of course not. You would keep baking bread, keep serving your loyal customers, and ride out the storm, knowing that people will always need to eat. Yet, the moment people buy shares of a publicly traded company on a screen, that basic business logic completely evaporates from their minds. They forget that a share of stock is just a fractional piece of a bakery, a railroad, an insurance company, or a tech giant. They treat it like a digital lottery ticket that loses its magic spell whenever the lights flicker. This psychological disconnect is precisely why wealth remains concentrated in the hands of the few who master their own emotions. Buffett's approach teaches us that fear is not an obstacle to investing. Fear is the very mechanism that creates the opportunity in the first place. Without fear, there would be no panic selling. Without panic selling, there would be no mispriced assets. And without mispriced assets, exceptional long-term returns would be mathematically impossible. The market would always be perfectly efficient, leaving no room for patience and discipline to reap their rewards. So the next time uncertainty looms and the market trembles, remember that you are witnessing the exact psychological crucible where wealth changes hands. The question is whether the storm will pass. History proves it always does. The real question is whether you will be standing on the shore with your hands over your eyes, running from the noise, or quietly waiting with cash in